Hello, today is Friday, August 1st, 2008. This is Brian Shannon from AlphaTrends.net, and the market closed. The S&P 500 lost about a half a percent, down 67 cents today, but it did maintain the ability to hold above these lows that we've been watching from earlier in the year. On the weekly basis, it did close right at that level, actually. So that continues to be an important level, obviously. But again, just another reminder, we've got a declining 50-day moving average, so you can't get too aggressive about any long side scenario until this market has had more time to heal. When we look at the 30-minute time frame, we see that this 129 level has been the area that I had been pointing to this week as uh, the level where a potential cup and handle breakout would occur. Then I said, well, if it keeps pulling back, then and the market can make a higher low from there, then maybe we're going to see an ascending triangle develop. Now, an ascending triangle is defined as a continuation, a bullish continuation pattern, and the problem is we're in a downtrend. They're not typically reversal patterns, so when we're in a downtrend, they have a less likelihood that they will continue to follow through. That's something to be aware of. But bullishly, we came down to the level that I'd said last night was going to be the important area, which was 126.10 to 126.20, and we closed right in the middle of that little range there, right on the 5-day moving average. So it appears as though there are still some defenders of the bullish case for this market in here. For the week, the market, the S&P 500 was actually up a half a percent, and we do have a higher low still in here on this 30-minute time frame. When we back it up to an hourly time frame, again, we're still in a downtrend. This line here now takes on a little bit more significance as it's also the location of that horizontal level that has been resistance and has potential to become resistance once again. It takes on a little bit further significance because if we get up there, we'll break the downtrend line and we'll break above horizontal resistance, which could give us the chance that this market can perhaps rally up towards that declining 50-day moving average, or perhaps somewhere in towards these areas in here where we've previously had some support in this market on the last leg up. Right now, though, it's too early to be looking for a buy. The market got damaged here on the 10-minute time frame. We saw a lower high yesterday, and today's opening confirmed the weakness with the lower low and that sell-off. It held right around that 5-day moving average, so there's still a lot of indecision in this market. Still a lot of reason to be concerned. Weekly time frame, we've got the close is right below, at least on a closing basis, below these levels right here from earlier in the year. And the more time it takes for the bounce to develop, the least likely it becomes. So a lot of mixed messages. You just can't really get too aggressive either way. As I pointed out in the live video broadcast yesterday and today, it's a great day trading environment. There's some really good opportunities out there. There's some stocks that are set up to the long side and to the short side, and it's a stock picker's environment. This Sunday at 6 p.m. Eastern, I'm going to be going over some of the best trading candidates for next week, and I'm going to post the clue for the password to that video broadcast. It'll be Sunday night. We'll go over how I came up with those ideas, what the ideas are, how I would view them in terms of risk reward, and also we'll be talking about some of the stocks that you guys are interested in as well. And that's going to be for people who've purchased the book. If you purchased the book before Sunday morning, send me a copy of your receipt, and I'd be happy to send you the password so you can get involved in that. The IWM obviously continues to be the strongest group here. It's still doing battle with the support, the prior level of support from May and June, and also right around that 50-day moving average. For the week, this market was up just over 1%, and this is where we see the most bullish scenario. We do still have a declining 200-day moving average, and this is a second test of that. So I think we're probably going to eventually come back down, but it's building a scenario that we need to pay attention to, which is getting back above that 72.5 and holding above there. Perhaps we hold off a test of those lows, at least for some time, and then we can continue higher in here. So above 72.5, I think that you've got to take the upside a little bit seriously, but you can't get locked into that bullish belief because of the larger pressure. You can't trust a breakout in this market. You have to protect yourself with stops and be ready to move to the sidelines quickly. And in some cases, fade those moves. That's not my style of trading, but some people like that. Right now, though, we have this level at $69 a share. That's been an important low from the pullback we experienced earlier this week. Market ran back up, pulled back a little bit more, holds above a rising 5-day moving average. Perhaps it's building for a breakout right now, though. Early next week, I think that $70.40, let's call it. If it gets below that, then you've got to really become very defensive with this group once again, because that could signal the next leg lower in the IWM. Let's take a look at the financials. They were up 7 cents today. For the week, they actually gained 4.3%. So a bullish week for a horribly bearish group. And we're doing battle for the second time with this 50-day moving average. These, I guess, are some of the lines I had not erased from the earlier broadcast today. But they continues to battle with the 50-day moving average and stuck below the lows from March and in June. So getting above that level, perhaps we see a little bit of a squeeze rally, but you got to remember again, don't trust these rallies for too long. Perhaps buying some call options is a better way to go about doing it because it defines your risk. And if one of these companies reports bad news and the whole group gaps down again, you won't be exposed as you would if you owned the equity or the ETF outright. So still a lot of reasons for concern in there. The XLF the best level of support in what would lead to, in my opinion, the chances of a bigger breakdown would be getting back below $19.90 once again. Let's take a look at the Qs and then we'll wrap it up. The NASDAQ 100 continues to be stuck in this range that it's been in for over a month, basically $44 to $46 a share. It threatened this week to break out, couldn't make it past this intraday high that it had made right here, back on whatever day this was, July 1st, I think. Today, bad, quick sell-off in here today, and came down. It's holding this trend line. Someone in the live chat said they thought one of the best things that they've learned is the fourth test of a trend line often leads to a break. Well, here's that fourth test, and looking at a shorter term time frame, this rally, higher lows and higher, this is looking like a bearish flag to me, right below and once again declining 5-day moving average. So be really careful with the NASDAQ 100. I don't know what can get this thing to turn around, but it's looking like a failed move, and from failed moves often come fast and vast moves, whatever you want to, whatever little saying you want to put in there. These are the potential levels where it may slow down, but there wasn't heavy trading here, and the market won't have much memory there. In other words, it's not likely to be a strong level of support, but we've got this support right now looking like resistance below a declining 5-day moving average. I think there's still a lot of reason for concern with the NASDAQ 100. We could be heading for a break, so you've got to be very, very careful with these stocks.